the survey did say that inflation expectations for the next 5 years on average ticked up from 2.9 to 3%. And I think that's because that was in reaction to gas prices, which have since come down. Then on the housing front, we got a surprise, a positive. New home sales up 7.5% month to month. I kind of think that was a fluke because if you look at the National Association of Home Builders, its index, it's really a sentiment index of how conditions are out there, are nearly as low as they were at the bottom of COVID, the low during the COVID crisis, and back where they were during 0809. So very weak sentiment there. And pending home sales, and this would be new and existing, are down 37% on a year-over-year basis. And then finally, as I mentioned before, home prices, as measured by CoreLogic S&P, have dropped for 3 consecutive months. Again, we haven't seen that since 0809. And I think that's why Chairman Powell started talking about rents and interest rates. I think we'll be surprised. Jeremy Siegel thought that we would see 2% interest rates next year. I found that very interesting. We do see one market suggesting that this point of view is correct, and that's the bond market itself. Bond yields peaked on October 22nd, I think, at 4.3% and are now down near 3.5%. That's a pretty dramatic drop in the bond market. And the yield curve is now, if you look at the 2s to 10s, I think it's inverted by 77 basis points. Again, a very steep inversion given the level of interest rates we're at. Commodity prices, one of the most influential from a sentiment point of view is oil. It peaked at $130 on March 7th of this year and is now down to 80, despite the fact that we're getting all kinds of reasons for the oil price to turn back around. One is OPEC is concerned at the excess supply out there and is threatening to cut production even more. A bit of a rebound. I think that's partly because the dollar has come down and commodity prices are based in dollars. The other market to focus on and try and glean some information from is the crypto market. And I think in our last In the Know video, we were remarking and impressed that Bitcoin had been much more stable. It was in the 17,500 to 23,000 range. It had been more stable than the equity markets and the bond markets. And we thought, wow, that could be a leading indicator. Maybe Bitcoin is going to be a leader in the next bull market. And then, of course, early in November, FTX went bankrupt. It does appear that there has been fraud involved. Now, what we took from the price break associated with it, if you looked at a chart of Bitcoin, as many technicians have from the beginning of this year, they've basically said this thing's going back to 10 to 12,000. That's where it has support. It doesn't have much support between here and there. Well, guess what? It stopped at 15.5 and it is now around 17. And regulators are beginning to understand this. The newest SEC commissioner, Jaime Lizarraga, still getting used to his name, he highlighted how important decentralization and transparency are. And a lesson learned from this crisis. And so from a regulatory point of view, the focus on those two variables could be very good for the crypto asset ecosystem. And then just to put into perspective the fallout from crypto, at its peak, the crypto asset ecosystem, all of it, I think there are more than 10,000 crypto assets, most of them or many of them will not be worth much, but there has been a lot of speculation. The entire crypto asset ecosystem hit somewhere between 2.9 and $3 trillion. Is now down to roughly $800 billion. Now, put that in context. Apple is a $2.3 trillion company, one stock. So that just gives you a sense of how early we are still. I think every time we go through a battle test of the crypto asset ecosystem, I feel better. I feel better. If you look at the trajectory of Bitcoin, while the swings are wild, as Jeremy Siegel said on our podcast yesterday, he doesn't think there has ever been an asset where more people have made so much money, even after these losses, in such a short period of time, 12 to 13 years. So our conviction is as high as ever. And you will see from our Bitcoin Monthly, which will be out on Monday, how our on-chain analytics look even after this battle test. The outlook is positive based on on-chain analytics that show massive capitulation that we typically see only at bottoms. And that's why we're so impressed. We didn't get back down to 10 to 12,000. A lot of the traders and hedge funds involved in crypto just look at the charts and press and press and press and press until they get what they want and get what they believe will happen. And yet the price decline in the NASDAQ back then was not as severe as our own price declines, at least for some of our portfolios. It makes no sense because the seeds for what is happening today in innovation were all planted during the 20 years that ended in the tech and telecom bubble and then the bust. There was too much capital chasing too few opportunities too soon. And that's why there were so many bankruptcies. Now, we do not believe that's the case. We are ready for prime time. And you can take a look at our research for many examples of that. And so what we encourage our companies to do, now that we are ready for prime time, is to invest aggressively right now to capitalize on some of the most important investment opportunities of our lifetime, of the last, really ever. We believe that the market cap associated with truly disruptive innovation, transformative innovation, will go from 7 trillion now, less than 10% of the global equity market cap, to 210 trillion in the next 8 to 10 years. That's a 30-fold increase. That's exponential growth. And I think that a reason a lot of people have trouble with our strategy